Hi, it's Ben Craig from IG Wealth Management. First and foremost, I hope you and your family are staying healthy and managing during this difficult time. Like you, I'm concerned for the wellness of my family and my community, so we've moved our office to work from home. As such, I'm reaching out to you in a new way, from my home to yours. Welcome. As we all do our best to stay well, we follow the advice of health professionals to eat properly, get enough sleep, exercise, and manage our levels of stress. On the topic of managing stress, it starts with acknowledging the actual stress point or emotion, assessing the risks involved, managing the risks we can, and doing whatever it takes to help protect against the risks we cannot control. During volatile times, financial uncertainty can be an added stressor. I can help alleviate some of that stress for you by sharing how we've built your personalized plan to include strategies that address risks to your long-term goals. I've been managing my clients' assets for over 20 years now. One thing I've learned is we can't control what happens in markets over the short term. But if you understand how we manage your plan to meet your long-term objectives, you can face the future with confidence and stay the course instead of panicking. As market volatility increases, investors typically want to move into safer investments, hoping to avoid further losses. Reacting to short-term market noise by making emotion-based portfolio changes can interfere with achieving long-term goals. History shows that by maintaining discipline and perspective during market downturns, a patient investor is often rewarded when markets return to their upward path. This year, we're experiencing significant volatility as a result of the global health pandemic. This event has created uncertainty, and during uncertain times, the world's stock markets tend to decline in the short term. That's why it's so important to have a diversified investment portfolio. When you diversify globally as well as by asset class, it creates stability in the portfolio during times like we're experiencing today. As highlighted on the slide, the broadest Canadian stock market, represented by the S&P/TSX Composite Index, was down approximately 20% for the year as of this taping. However, many of our managed solutions were only down a fraction of that amount. Proper portfolio construction reduces risk and provides downside protection. For the last 11 years, we've been enjoying one of the longest economic expansions and strongest bull markets in history. But you wouldn't have known it on March 9, 2009. On that day, the S&P 500 index was down by 50% from its previous high. And many people believed capitalism had failed. Taxpayer dollars were being used to bail out the global financial system, and the forecast for the future was bleak. There was little optimism for the stock market, and it was believed that economies wouldn't grow for many years to come. Since March 9, 2009, investors have lived in constant fear of the next financial crisis, as you can see in this slide. We've endured many events that seemed at the time to be permanent barriers to future financial success. In each one of these instances, and many others, the first reaction of the stock market is to decline. But then markets eventually rebound. In fact, over this ongoing cycle of crisis and recovery, markets have continued to reach new highs. As the graph demonstrates, the S&P/TSX has delivered an annualized return of 8.93% since 1956 and has proven to be resilient through the worst market conditions. Over the same period of time, there have been many instances when the S&P/TSX declined by more than 10%. This chart illustrates that this has happened 24 times since 1959, yet each time the markets recovered and achieved a higher level. Throughout history, equity markets have always experienced periods of volatility. Despite this, they continue to be resilient. Staying the course is extremely important during periods of volatility, as this disciplined, patient approach enables investors to fully recover from these periods and achieve their long-term investment goals. Many of the strongest market returns occur in a period immediately following a sharp decline. Since 1950, following the worst 12-month periods of performance by the S&P/TSX, the market made solid gains just 12 months later, with only one exception. And within 5 years, the markets were up significantly, meeting and exceeding long-term return expectations. In order to take advantage of those returns, it's important for investors to continue focusing on a long-term plan, stay the course, and remain invested. Those who panic and exit the markets, even for a short while, risk missing great opportunities when the markets recover. It's impossible to accurately time the market over the long haul, so staying invested is key. Now let's go through the 5 principles of your living plan. Investing for the long term is one of the best strategies for offsetting the impact of short-term market volatility. This approach will help you participate in stock market growth and achieve positive results. Financial markets can quickly move in and out of favor. For example, when stocks are rising, bonds may decline in value. Equities and other investment types may perform better in different market conditions. Staying invested ensures you are always capitalizing on the upside of the market and reducing the impact of short-term market volatility. Although the probability of negative returns in the short term is relatively frequent, the following chart illustrates that, more importantly, the possibility of earning a positive return greatly increases as the investment term lengthens. A diversified portfolio provides clear expectations. Deciding on what to invest in can be a daunting task. Whether you're a new or experienced investor, investing in a diversified multi-asset portfolio removes the guesswork of how to successfully invest over the long term. This chart demonstrates that, in many cases, the top performing asset category changes every year. As well, asset categories that are among the best one year could be among the worst the next, while others can remain somewhat consistent year over year. By diversifying across different asset classes and investment styles, investors can offset overall risk and increase portfolio returns by balancing exposures in both positive and negative market environments. Using a thoughtful approach to portfolio construction will properly diversify your assets and reduce the negative effects that any individual security or asset class may have on your portfolio's performance. Financial markets don't always move in the same direction. As mentioned earlier, when stocks are rising, bonds may be in decline. Similarly, different types of equities or even investment styles are more successful in some market conditions than others. By carefully diversifying your portfolio, we can reduce your risk and enhance your chances of successfully attaining your long-term goals. Since 1948, the S&P/TSX has experienced 50 positive years compared to only 22 negative years. In other words, it has provided positive returns more than 2/3 of the time throughout its history. In the chart, annual returns since 1948 are plotted within their respective ranges of returns. The result is fairly normal distribution in what we statistically refer to as the bell curve, with most returns staying within the range of 0 to 10%. In particular, note how the S&P/TSX declined by 33% in 2008, but then reversed course in 2009 with a gain of 35%. Generally, negative returns tend to be followed by positive returns, and those positive returns are typically greater than the negative returns. That's why it's so important to stay the course to achieve your long-term investment goals. All investors love the prospect of a rising stock market. However, once the market declines and prices approach historical lows, many investors become defensive and retreat to the perceived security of cash or money market instruments. While nobody enjoys watching markets decline over the short term, the chart clearly demonstrates that those investors who can focus on the long term and stay invested will stand to gain. For example, an investor who remained fully invested in the S&P 500 index from January 1st, 1990 to December 31st, 2019 realized a 7.7% annual return. Conversely, an investor who missed the 50 best days of the S&P 500 over that time period realized an annual compound return of negative 0.4%. A combination of discipline and perspective is the key to reaching your long-term investment goals. In contrast, obsessing over daily market fluctuations and short-term noise can be a surefire way to fall short of your goals. One way to achieve this fine balance is having a long-term plan and then, most importantly, sticking through it through all market conditions. While this may sound simple, recent market conditions have put investors to the test. Veering off course from a carefully thought-out plan can turn a temporary loss of confidence into a realized loss on an investment portfolio if you panic and lose your focus. Every IG Living plan is developed with a holistic viewpoint and is synchronized across all aspects of your financial life. When you have a holistic financial plan developed specifically for you with expert advice, you know when and how to act, and you can be confident in the decisions you make. IG Wealth Management is in this with you. We've tested our approach with cutting-edge predictive software, and we've partnered with leading investment managers from around the globe to help deliver results. Together, we can work on creating and maintaining the plan that is most suitable for your unique circumstances. Our team works together to produce not just good, but extraordinary results. We take coordinated action. We have the ability to move faster as conditions dictate, without losing intelligence, discipline, and focus. While we can move quickly, we do so with complete conviction and confidence. It's important not to be distracted by the headlines, daily news, and constant market fluctuations. Remain focused on your IG living plan. The plan should be reviewed on a regular basis, especially during times like today, to ensure you're on track to achieve your specific goals and dreams. Your plan will provide clarity on how to stay the course and capitalize on any attractive opportunities that present themselves. Your regular investment statements serve as a snapshot at a moment in time. For example, you'll soon be receiving your investment statements for the end of March, and it will show the value of your portfolio on that day. During market downturns, it's natural to feel nervous or unhappy if you see a financial loss on your statement. I definitely understand how you feel, but I also want to remind you that this loss exists on paper only and is not realized until the decision to sell is made. So a loss is not a reality until you actually sell, and as your plan has been designed for the long term, our recommendation is to resist acting impulsively and stay invested. When building your IG living plan, it's important to stress test it. This means using our leading-edge financial planning software to determine the probability of success of your current plan. This advanced technology is available for your plan. If you'd like to review it further, we'd be happy to discuss it with you. Most projections that are created by software will use averages. For example, if you projected a 5% compound average annual rate of return, the software will model your plan as if you were going to achieve a 5% return each and every single year. We know this is not a reality. Some years will be higher than 5% and others will be lower. In other words, you will experience fluctuations in return from year to year. These fluctuations, or what we call sequence of returns, matter. We run several rigorous trials of how you could achieve the compound return you have projected to model current events like the ones we're going through today. We then determine your probability of achieving your goals. Our focus is to get your plan as close to 100% as possible, which will help you look toward the future with clarity and confidence. Over the course of our investment years, there are only a limited number of times when major market corrections will lead to highly attractive investment opportunities, and we believe this is likely one of those times. As legendary investor Warren Buffett has been known to say, "Be fearful when others are greedy, and greedy when others are fearful." Quite often, when markets appear at their bleakest and everyone is panicking, a focused long-term investor stands to benefit the most. As we go through this difficult experience of COVID-19 and its profound impact on the global economy, things may seem overwhelming from time to time. However, I'm grateful to have the support of my family and the community to help me cope with any fear and stress that I may have. In turn, the support I receive gives me the strength to continue focusing on your well-being. I believe we are well positioned to withstand these challenging times, and I truly want you to feel confident in the rigorous planning that we have done as we work together to meet your long-term goals. Thank you so much for your time, and I hope you and your loved ones stay safe and healthy.